Executive for the Tax, Customs and Excise Institute, Ms. Mamiki Leola. At this point, and I'll be your program director, I'm Janine Mkwana from the Sars Media Unit. At this point, I'd like to call on Mr. Mamonia to address members of the media, please.
Thank you, Janine. I just want to start by just apologizing that the Minister or Deputy Minister are not here. So you don't read any signals to that. I think the choice we were faced with was to, either we delay this function for a few days so that the Minister could have been present, or we continue with the press conference. And we just thought that it's been a tradition that we always do it as soon as possible after the 31st of March, that we should not delay, and therefore we're going ahead. Just for the record, the ministers had to go to New Development Bank meetings in Cape Town, and the Deputy Minister is also occupied. There is something called, I guess, an election around the corner, so we did feel that despite this, even the DG is busy in Cape Town. So for all those reasons, none of my immediate bosses are here, and they normally come and they sit here. So without further ado, and look, I think it's fine, because really today is about SARS and what's happened. The numbers that they'll tell, even though we've seen it, but it's like we've just seen it. So we're also absorbing it as the Treasury. But SARS has all the answers, and bear in mind that this is, just something that they've also seen. So at this stage, it's preliminary, I would guess. We still jointly will do lots more analysis and so on the numbers. But yeah, without further ado, I thought my job was just to explain who's in front, who's not here at the panel.
Thank you for that. So now that we have that out of the way, just an announcement before I call on the Acting Commissioner. Documents pertaining to the Acting Commissioner's statement, as well as a media statement on the figures, will be available as the Commissioner is making the announcement. It will be available online and by an email that will be sent to members of the media. So that is how you'll be able to follow the analysis as well as the presentation today. So at this point, I would like to call on Acting Commissioner Mark Kingan to present the revenue outcomes. Over to you, Acting Commissioner.
Thank you very much, Janine. And colleagues from National Treasury, it's not only just Momo here, there's one other as well. Members of the SARS Executive Committee that are here, a large contingent of SARS management and other staff that are here, SARS colleagues across the country, fellow citizens of South Africa, and obviously members of the media, the most important here today. A good afternoon to you, and thank you for coming and joining us today. Today I'll be presenting the preliminary revenue collection results for the 2018-19 financial year, which are preliminary figures, and I really want to emphasize that. As has been correctly stated, we are still digesting some of this, and we'll have more analysis as we go forward, and we need a more continual engagement with the media pertaining to numbers as we get them, even on a monthly basis. The final audited figures will be available around mid-April is our expectation. Our journey began with National Treasury and SARS setting a printed estimate, I think you well recall, of 1,345 billion as at the 2018 budget speech, based on real GDP growth of 1.5%, nominal GDP growth at 6.9%, and a CPI inflation of around 5.5%. The slow improvement of production and employment following poor investment growth in 2018, as well as the moderation in global trade and investment, presented a weaker outlook for the economy. In line with the muted economic performance, the tax revenue estimate for the 2018-19 was revised downwards. The revised estimate for 1890 anticipated a growth of 7% in revenue over the prior year and an economic outlook for nominal GDP growth was 7.2%, obviously 0.7% for real growth. Consequently, the expected tax to GDP ratio was revised to 25.7% for the 18-19 year from the 26.1% medium-term budget policy estimate. Following the revenue and GDP revisions, tax buoyancy was at an estimate of 0.98% for the 18-19 year compared to 1.21% that was estimated in the MTBPS. The printed estimate was revised to 1,318 billion at the MTBPS, a statement in October of 2018, and as you're all aware, it was further revised to 1,302 billion in February this year. For the financial year ending the 31st of March 2019, SARS collected a preliminary amount of 1,287.6 billion rand. The gross amount collected, in other words prior to refunds, was 1,575.4 billion, which was offset by refunds of 287.8 billion, resulting in the net collections of 1,287.6 billion. The net revenue outcome represents a growth of around 71.2 billion, which is 5.8% compared to the 2017-18 financial year. Against the 2018 budget estimate of 1,345 billion, this results in a deficit of 57.4 billion, which is 4.3% drop, and against the revised estimate, it's another 14.6 billion drop, which is 1.1%. Once again, these are preliminary figures and will be subject to a detailed financial reconciliation and obviously a final audit. Gross collections grew by 8.6%, whilst refunds recorded a strong growth of 22.7% year on year, following specifically the announcements made by the Minister at the medium-term budget policy statement that the whole VAT refund envelope and how that is applied, that we got a proper understanding where additional refunds have flowed over the period. Just dealing with refunds, as announced, the requisite fiscal space was created for SARS to reduce the credit book on VAT refunds. SARS reduced the credit book on VAT refunds from where it peaked at 41.8 billion rand, and this is specifically just for VAT, in September 2018 to 24.7 billion by the end of the financial year, resulting in a 16.4% increase in the value and 6.3% in the volume of refunds going back into the economy. Just to repeat that, 16.4% up year on year. In aggregate, SARS paid out 287.8 billion in refunds in the 2018-19 financial year. A total of 30.5 billion was paid for PIT refunds, reflecting a 13.8% increase on the previous year. CIT refunds totaled 22.2 billion, representing an 8.7 billion increase in payouts compared to the prior year. That is a 63.7% increase in refunds in CIT. This is predominantly driven by the overpayment in previous periods of provisional tax. Turning back to VAT refunds, for the year, they totaled 229.2 billion, exceeding the estimate by 1.2 billion, reflecting an increase of 19.9% on the previous year. Growth was driven by the 9.3 billion increase in payments to the small and medium vendors, that size entities, while large vendors received 5 billion more refunds than in the previous year. So it's quite significant. Small vendors received an increase of 13.2% refunds in respect of VAT. There's also an increase in diesel refunds from the previous year of 93.3%. 2.8 billion rand more refunds for diesel was refunded compared to the previous year. Due to, and it's obviously driven in part by the reliance on diesel for electricity generation. If we turn specifically now to the tax type performance, the main sources of revenue that contributed to the 1,287 billion collected were personal income tax, and I'm not going to give the figures here, but which contributed 38.3%, VAT, which contributed 25.2%, company income tax that contributed 16.7%, and customs duties that contributed 4.3%. Pay-as-you-earn collections for the year grew by 7% to 477.4 billion, despite significant job losses, moderation in wage settlements, and contraction in bonus payouts. However, this growth was dampened by lower share option payouts. We've definitely seen that, mainly from the finance sector. Moderate public sector annual increases, job losses in the formal non-agricultural sector, and lower bonus payouts, as I've already said, in the finance sector. There was double-digit growth in the domestic value-added tax since May 2019 due to the benefits of the 1 percentage point increase of the VAT rate. This resulted in strong growth rates in both the large business and SME segments of 9.8% and 14.8% respectively. For vendors who paid in both years for the relevant periods, domestic VAT would have grown by 3.9% if there was no VAT rate increase, compared to 11.2% for that sample with the rate hike. This is why significant growth was achieved despite weak growth in retail trade sales, which continued to be under pressure. Full-year collections yielded 378.8 billion, of which 83% was received via the e-filing system. Turning specifically to corporate income tax. CIT collections contracted by 2.5%. The contraction is on the back of significant number of CIT refunds that had to be paid to the large business segment and relate to multiple periods that were under audit review, as well as the continued efforts to clear the IT credit book. Furthermore, the continuing power cuts obviously do impact business, and we need to acknowledge that. Just out of interest, as we look at CIT specifically, if we look at the top 30 companies within our large business space, we had an over 11 billion drop in provisional tax payments in that space specifically. Turning specifically to PIT, provisional payments we saw in August were 37% year-on-year up, but that dropped back to 18.4% for February. We saw a significant drop in February. But it's mainly due to non-repeat transactions, specifically relating to capital gains tax, which was declared in previous years. We need to acknowledge that we do need to get on top of what are once-offs, and specifically in capital gains tax, because it's difficult to estimate unless you know what these once-offs are. We will be making certain changes with regards to our provisional tax declarations in due course. There was strong growth in import taxes of 14% for the first three fiscal quarters, after which transactional data and merchandise imports did not meet expectations during some months of the final fiscal quarter. Payments that are part of the 13th deferment statement exceeded all expectations, which resulted in an overall outcome for customs growing at 13.9%, which is marginally above what we expected of them. Just turning to some other revenue initiatives that the Revenue Service had in place, and I'd like to just focus on one or two of those after I have a sip of water. In relation to the Special Voluntary Disclosure Program applications, a total of 2,030 applications were received in August 2017. To enhance revenue collection, we did communicate with as many of these applicants as possible, including those who had estimated revenue values on the application forms to provide their updated figures. We also had an influx in terms of normal VDP, and the special VDP and the normal VDP yielded a total of 3.1 billion rand to the FISC for the financial year, a significant amount. We continue to use third-party data matching, and this is definitely an area that you're going to see continued growth in. Significant compliant interventions were held over the financial year related to the matching of third-party data with, amongst others, including information from the Deeds Office, information from interest certificates, and you'll see significant improvements in that regard coming forward, from banks and third-party appointments relating to third-party appointments. Another area which we focused on was the invoking of paragraph 19.3 of the 4th schedule. I think you're all aware that SARS may request additional payments for provisional tax based on the latest estimates of financial performance. This year, SARS collected 10.9 billion from large business and 1.5 billion rand from small business relating to the paragraph 19.3 interventions. This is an increase on the last year of 728 million. Turning to customs, 4.4 billion worth in customs interventions has been collected. This included increased customs visibility at ports of entry, amounting to about £500 million, enforcement interventions to the tune of 571 million, and customs audits of 3.3 billion. Now, I just want to pause there for 2 seconds. In the detail of the figures, you will see that one of the tax types that is up is excise duty on tobacco products. And you know that we've taken a bit of flack in that regard, but we are definitely seeing a turnaround due to interventions both in the customs space and within our excise teams. That we've made specific interventions both in the manufacturing and the import, and even in the past week we picked up 3.3 million rands worth of cigarettes being smuggled in a sealed area in a container. So there's significant improvement in these areas. Interestingly enough, our contact centres achieved a sum of 7.4 million taxpayer engagements, consisting, and more importantly, 1.7 million outbound calls, and that is primarily revenue driven, and 5.6 million inbound calls, a considerable number of calls that were made. Our taxpayer service points attended to 6.7 million walk-in taxpayers, and also we've got a specific system that allows us to do outbound calls. They did over 738,000 outbound calls in that area. We do need to reduce, and some of the things that the new commissioner will be considering, how we reduce the number of walk-ins into our branches. If you consider 6.7 million walk-ins, it's not sustainable, and we need to find better ways of serving our clients that they do not need to walk in. Returns without payments, there were 64,000, just over 64,000 intervention with a value of 1.6 billion. This is where people submit a return, say they owe us, and they just don't pay. 1.6 billion rand. That means we have clawed back 1.6 billion rand where returns were submitted but without the payment. This is before it is actually reflected in the debt book. Speaking on the debt book, we have seen a growth in the debt book, as I have it here today, of around 14 billion. The debt book currently stands at around 145 billion rand, and that is of deep concern to us, and we need to find ways in which we can continue to reduce that debt book and obviously add finances to the fisc and generate revenue for the fisc. Other organizational interventions for the 2018-19 financial year. The primary objective for management was to address internal efficiencies in the short term through the following interventions, some of which also emerged as recommendations in the Nugent Commission of Inquiry report. Last year we began the journey in re-establishing and solidifying the unit dedicated to the service provision of large business and high net worth individuals, known as the Large Business Centre. Whilst this process is still underway, the model, which would have to be assessed by the incoming Commissioner, includes dedicated relationship management aimed at speedier resolution of transfer pricing queries, calculation of interest, refunds, audits, etc., etc. More importantly is that the approach is to have a full compliance view of the taxpayer's entire tax portfolio, which would allow a compliance verification of the mother company and all the subsidiaries in the case of conglomerates. And I want to pause there a while to say the 1st of April sees the opening of the doors of the Large Business Centre. And it's an important milestone for us. Yes, we did have preliminary work happening from the 1st of December, but it's an important milestone. One of the key areas, and I want to just pause here a while, is I'm very worried with the pipeline of audits, settlements and engagements, appeals, etc., within the audit pipeline in the large business centre. We have seen a significant decline in this area over the last few years. We need to continue focus in this area because this is the area where transfer pricing is happening, where transfer mispricing is happening, base erosion and profit shifting is happening. We need to be on top of our game in this space insofar as doing audit work in a professional and speedy way. And that is our mandate to the large business centre. Very importantly, we've re-established, I'm pleased about the re-establishment of the illicit economy unit and the speed at which the enforcement unit has been able to tackle an inventory of outstanding tax non-compliance cases through the establishment of the unit. I think many of you have seen what has been stated in the media. I will not be commenting on specific taxpayers, and we did not go out to the media in this regard. Somehow it was picked up. The illicit economy unit has seen the reorganization of our audit and investigation capability and focuses on serious non-compliance emanating from industries such as the cash and carry and gold industries, tobacco and cigarette industry, VAT carousels which continue to severely deprive the fisc, clothing and textile imports, poultry, second-hand motor vehicles and the fuel industry, amongst others. Special efforts are also underway to further strengthen controls and improve compliance within the tobacco and cigarette industry. We have made progress in addressing illicit fuel movements. We're very gratified with that, and the mixing of certain products, which obviously yields to lower price of the fuel, specifically paraffin and diesel being mixed. And we are looking at improving the coverage of the road fuel testing units. I'd like to applaud the team for the inroads they have made and for working tirelessly in a space that encroaches on one's personal time and often one's security. If I may just say, people in our teams are being threatened. And I need to acknowledge the staff that it's a tough job dealing with tax criminality, and they need every support of the country in rooting out non-compliance, which is simply there to deprive the fisc. It must be noted that the inroads that have been made in this financial year will only really yield a revenue return in the next 3 to 5 years. But the work has begun, and this gives me much assurance for the future, both of our fisc as well as our organisation. Turning just to anti-corruption, in response to some of the Nugent Commission's recommendations, we've renamed our internal fraud investigations capability to Anti-Corruption Unit to enhance the unit's visibility and the anti-corruption functions of that unit within the organisation. The unit's primary function is to ensure that high ethical and professional standards are maintained within the organisation for public trust and credibility, traits that are important for the Revenue Authority to conduct its business. The unit also serves as a vehicle for internal whistleblowing. The Compliance Unit and Compliance Programme. One of the key drivers in revenue collection is the level of tax compliance and tax morality of taxpayers and traders. SARS is concerned about the fact that compliance levels have declined over the past few years. And I think we are seeing the results today of that in the figures. The figures are partly that, they're partly certain efficiencies within our organisation that do need to be addressed. Talking about the compliance program to address these compliance challenges, which are also highlighted by the Nugent Commission, SARS has re-established the compliance unit. Also during the financial year, a compliance program was developed that outlines where and how we will be tackling non-compliance in areas such as trusts, large business and transfer pricing, VAT and customs and excise. This program will be developed further with the incoming Commissioner. Just turning to tax season and the audit period, I think you're all aware that the tax season for personal income tax is our biggest engagement with taxpayers. We have been working on how to make tax season an efficient period from an internal resource perspective, but also from a taxpayer perspective. It is burdensome for the taxpayers in many ways to stand in those queues. Last year's tax season was shortened to allow more time to finalise compliance and more in-depth audits. We are also looking at making our communication with taxpayers, such as requests for supporting documents, more specific in order to speed up compliance verifications. I want to just pause there a while. Much criticism has been levelled against our IT department in the past year. And our primary driver in this space is our e-filing component as such. And it gives me great pleasure to tell you that we have invested a significant amount, which maybe my Chief Officer of Finance can come in with the exact amount, 225 million, into a new e-filing infrastructure. It is ready to rock and roll. It's in test phase. We're hoping by around the 25th or so of this month after Easter to have the system up and running. There's a whole team that is focusing on the testing of this new infrastructure. So it's a significant investment, and it puts us on the cutting edge of the technology in that environment. And on top of that, there's certain benefits that will flow. And in the filing season that's going to be coming, we're going to see significant changes in the taxpayer engagement. So just with that, reflecting on the past tax season, but looking forward to the future one, we're going to see significant changes. And our teams have been working very hard in that regard, both in respect to the IT and obviously the programming thereof. Turning to the service charter was launched during tax season last year, I think you recall. The service charter is a document that guides service standards of SARS to the taxpayer and is still in the process of being rolled out. We are not there yet. So we are not adhering in every sense to the service charter as yet, but we will continue to strive to do so. Stakeholder relations. One of my priorities during the financial year was to focus on stakeholder relations and accessibility of our stakeholders in industry, both within the public and the private sector. We have entered key partnerships with the Financial Intelligence Centre, the FIC, and an accord with the Banking Association of South Africa was signed in November, outlining important areas of collaboration under our respective legislative frameworks, which I'm hopeful will contribute to tighter system controls and revenue efficiencies. We have also signed an agreement with key professional bodies in the tobacco industry and with Business Unity South Africa. I am pleased that our partnerships in the Southern African Customs Union are active. SARS and the Swaziland Revenue Authority are currently undertaking a quality assurance of real-time exchange of customs information and data. In January, SARS, the National Treasury, and the OECD renewed its cooperative agreement on a number of key tax development areas. While the above inroads have been made, the revenue borne from these efforts, in particular the enforcement, digital and business investments, will most likely be seen in the next 3 to 5 years fully. We're hoping in a shorter period. In closing, these are my own words, not written into my speech. I must say, reflecting on the year, and really I started acting in the position on the 19th of March, which was just prior to the last financial year. I must say it's probably been my toughest year, but been my most fun year, in a funny way. I don't know how else to explain it. But just reflecting on it, I want to just say thank you to the staff specifically, to my colleagues who are here, for the tremendous support that I have had over the last year. I owe an immense amount of gratitude to a number of people and stakeholders for their support. The President and the Minister of Finance were instrumental in commencing a journey for SARS to rebuild through the Commission of Inquiry into the Tax Administration at SARS, and, very importantly, the permanent appointment of a permanent commissioner, as was announced last week. I want to thank both the President and the Minister of Finance for their unwavering support to our organisation. I want to extend a very warm welcome to the incoming Commissioner-designate, Mr. Edward Kiswetter, who I am confident will add much value to the organisation and who in turn will find value from the quality of SARS staff as I have seen. We pledge our support and commitment to taking SARS forward. We want to make a success of this organization. And after what I've seen in the past year, there is so much good in our organization. Yes, we've come out of a tough period, but there is so much hope for the future. And we must be committed to giving our full support to Mr. Edward Kisveta in taking this organization forward. I am certainly committed in that regard. Thank you to our stakeholders and stakeholders bodies across sectors, the tax practitioner bodies, and even members of the media for their faith in SARS and wanting the best for the organization. I now want to turn specifically to the staff of SARS. There are many acting appointments that were put in place to ensure leadership across the organization. I want to thank the teams across the organization, across all levels, including the regions, for stepping up to the plate and demonstrating resilience that SARS staff are known for. I value your expertise and innovation, and I look forward to seeing more of it being expressed towards service excellence to the tax-paying public. With that, I conclude my statement, but thank you very much.
Thank you very much, Acting Commissioner. Mamiki Leola is the Executive Manager of the Macroeconomic Research Unit in the Tax, Customs and Excise Institute in SARS, and I'm going to be handing over to her now to provide a brief analysis of the numbers.
Thank you, Janine, and good afternoon, colleagues and the media. Okay, there we go. I have been tasked to just go one level deeper into details around our revenue performance and the context around which this revenue outcome came to bear. And in giving the context, we'll also look at some of the assumptions that drove the numbers. As the Commissioner has already indicated, we've gone through a journey this year with respect to our revenue estimates, and we are concluding today with announcing our results. We also just want to take us through the fiscal policy that would have underpinned the revenue outcomes that we saw today, and do a bit of self-introspection and get an understanding of the administrative efficiencies that perhaps we should be looking at, and then concluding with remarks around the revenue outlook and what the new challenge is for the new fiscal year. As you are aware, in the last 4 quarters of 2018, we saw 2 months of contraction in the first half of the year, and we saw some recovery in the last 2 quarters of the year, growing by between 1.4% and 2%. If you compare the results of 2018 in relation to the previous periods, starting in 2010, you'd see that in 2010 we had an average growth rate of between 3 to 5%, and that growth has tapered quite significantly and reflecting a much slower growth trajectory. I think for us also understanding that we are in a contracted downward phase. If you look at the Reserve Bank publications, it indicates that since December 2013, we've been experiencing a downward phase in our economy. The Commissioner has highlighted some of the key taxes that have performed. I think for us just to look at the first 3 lines and the 3rd column there, you'd see how our revenue performance underwent. Gross receipts were 12.5 billion behind our expectations.
I'm impressed you think people's eyes are so good.
Yes, some of us youngsters can still see Momo. Refunds are 2 billion behind, and overall resulting in 14.6 billion behind. I think the Commissioner has lifted some of the taxes that we are concerned about. PIT net was 5.3 behind. I think for us the big concern was also the significant outflow of refunds in the PIT space. The next big item that we sort of kept an eye throughout the year was with respect to CIT. I think in June we missed our estimate. In December we missed our estimate, and I think in February and March we just saw revenue buckling under pressure. What we also saw was with respect to refunds, almost a 3 billion difference against our estimate. The refunds that were paid out with respect to audits that were conducted and refunds that were sitting in the pipeline. I think although we have missed our target, we do need to celebrate where good work has been done. And I would like to particularly mention our colleagues in the customs environment. You'd see there the very few green arrows with respect to performance against estimate. Import VAT was 961 million above estimate, and you see excise as well being almost 500 million above estimate. So we would like to really, really thank our colleagues from the Customs and Excise Division. Yes.
It's so specific.
If we look at the performance by the various segments that we manage, you'd see that in the past, the growth rate of the SMEs, so the small and medium-sized enterprises, has carried SARS to some extent. And this year, you'd see that our growth has moved from 12.3% in 2016-17 down to 7.9% in 17-18, and in the previous year that we've just concluded, that growth slowed down further to 7.3%. I think for us, the big disappointment is if you look at the blue line, the large business sector growing at about 4.6% in the past 2 years, in the past 3 years, and last year contracting by 0.6%. I think for us, that also was a big contributing factor to our revenue performance. And sometimes when you give analysis of the revenue performance, there's always a tendency to want to look at one variable and ignore the others. And perhaps sometimes we do need to bring all of these variables and all of these factors to the table to just indicate how complex it is when we are trying to manage taxes. So we've tried to get our specialists, our various tax product specialists, to just give an indication of, in the 2018-19 year, what were the big drivers for the taxes that they are overseeing. In the PIT space, you'd see that tax policy has been a big driver with respect to Treasury not making the full adjustments for the tax brackets. The pay-as-you-earn that's payable on the payout of share incentives has been another big factor that we had to consider in 2018-19. CGT, there were a few individuals that in the previous year had disposed of assets and either made some gains that we did not obviously see in the 2018-19 year. The tax rates, obviously, the changes in the marginal tax rates has an impact. Our employment or labor market, that has an impact as well. If we're not absorbing more people to contribute to our to the wage bill, that also has an impact on our the growth of our PIT. Wage payouts, it's obviously a sensitive topic here at SARS, but generally if you look at the entry levy studies, you'd see that the wage settlements have really come down significantly. And I think also if you look at various sectors, particularly in the financial services sector, the bonus payers that they make now are very, very much lower than what we see in the previous years. In the CIT space, I think the key thing that has been a key driver of the revenue performance in CIT has been the manufacturing sector. It has been in the overall economy in successive quarters of decline, and we've seen that translate also in the tax world. Domestic VAT, I think the big speaking point for domestic VAT last year was the 1 percentage point increase in domestic VAT that we estimate has probably brought in around 20 to 22 billion of additional tax revenue. I think the other items there you may be familiar with, but I think for us, we just wanted to highlight to you what were the big drivers for us. And in the import taxes space, in addition to the usual story about the volume and the value and the currency and the key commodities, we also saw shifts in the purpose codes which are being declared, are being used to declare goods into the country, goods that come in duty paid versus goods that come in and are being stored in the warehouse.